Thank you all for joining. I'm here to introduce our first presenter of the morning, David Samra. I've had the pleasure of getting to know David over the past 20 years, basically since he joined Artisan Partners. I was on the allocator side of the business back then, evaluating David and the International Value Fund, which was just newly launched. Over the 20 years since, we've had many wild market prognostications, ranging from the death of value investing, who would have thought that interest rates were actually going to rise, as well as the death of active management because quants were going to eat their lunch. Yet through it all, one thing has remained constant: David's unwavering commitment and passion for fundamental value investing. During this time, David has methodically honed his craft of identifying great businesses and buying them at deep discounts to his assessment of intrinsic value, all the while assembling a high-quality portfolio that meets his standards of both quality and valuation. Having evaluated thousands of track records in my day, I've seen how easy it is to actually beat the market when the wind is at your back. The true testament of a portfolio manager is how well they do when the wind is in your face. It's very hard to distill David's success in one statistic, but when you look at the since inception performance of the International Value Strategy, it's hard to argue that it's nothing short of amazing. David has beaten the EFI index by several hundred basis points annualized net of fee since inception, as well as the S&P 500 by over 100 basis points annualized net of fee since inception. Truly amazing performance. I've had the pleasure of watching David both as a client as well now as in the front row as the president of Artisan Partners, hone his craft and develop one of the best track records in the business, build one of the best franchises in the business, and now broaden it out to also include the International Explorer Fund, which you'll hear a little bit about shortly. David, it's been a great 20-year ride. We're looking forward to seeing you for the next 20 years. Thank you.
Thank you. You forgot to mention that you kept my fishing boat from beaching. Well, that was very nice, Jason, and thank you all for coming today. You know, I went to Columbia Business School 30 years ago, and I've re-engaged with the school over the last, more deeply over the last 6 or 7 years. And I put together a group of material to potentially teach a class in international investing, and it's been sort of sitting on my desk for the last couple of years. And as I was putting together the material, I started looking for books out in the marketplace that could be used as reference material, and there are none. And there are books on international investing, but none that sort of look at it from almost like an auto mechanic standpoint. Like, we get under the hood and we do the digging, and we see what goes on a micro basis, individually with businesses, and on a micro basis on how to think about people and culture and how to collect dividends. And these are all the practical realities of investing that take up our day. And so we sort of live this day to day. And I think it's an interesting topic, and I think it's relevant for those of us who grew up in the United States and have an understanding of investing that is based on living here, right? And investing in the United States in many ways is very privileged. Everybody speaks the same language. We have a legal system based on the rule of law, and we have one political regime. Probably nobody really likes it, but we have one. And when a U.S. investor then sort of goes over the border and starts placing their money in a foreign company, they may not recognize or fully appreciate that they're investing capital under meaningfully different circumstances. And I could give you a very simple example. 2 or 3 years ago, you would find a stampede of growth stock investors and individual investors that owned Alibaba. And then reality set in. You know, what does it mean to be invested in a Chinese company? What does it mean to be subject to the rules and the cultural differences of owning a Chinese equity? Well, people found out. And I think that that's probably, like I could stop talking there and then you'd all get the point, but I've got to take up a half an hour, so we're going to talk about a lot more stuff. So I thought it might be helpful to go through some of these differences. So it would create a little bit of awareness and complexity about non-US investing. And at the end, and this is really interesting and something that's intuitive to anybody who invests outside the United States, is that investing outside the US actually lends itself to value investing, and I'm going to spend a few minutes on talking about that. It's really good to have that screen there. Okay, let's point out something obvious here, or a few things that are obvious. Not everybody speaks English, and we all do. And it's a pretty simple observation, but it's just harder to get information outside the US, and that complicates due diligence. It's much more difficult than gathering information in English in America from Americans, which brings up a second point, is that they're in a different time zone, right? And you have to sort of internalize that and what it means in terms of when you're communicating with people. And you really do need, and this is something that Artisan is great at, and you really need to have a 24-hour-a-day operation. Research in the office has to be, and we talked about this last night at dinner, it has to be complemented with boots on the ground. We have long road trips. They're necessary to gather information. Most successful investors that I know the people that are running the businesses that they're invested in, right? People make all the difference. In order for us to know the people who are running the businesses that we're invested in, especially at the scale that we're at now, it's not only the people that are running it, but the people on the board and the people that are pushing decisions, the families that control these businesses, the advisors that are providing advice to these companies. There is no way to be able to make investment decisions without having this network, this source of information available to you. And that comes with cumulative knowledge, it comes with experience and boots on the ground, and it takes years and years of relationship building, built based partially on credibility. Who you are, how you present yourself. When you show up at a meeting, you're prepared, and you're not dressed like a goofball. Like you can't imagine how some investors show up and what they do. And it's based on your reputation. All those things are very, very important in helping you build that network. So travel and time spent also helps understanding cultural differences. Several of them are listed here. The key question is, are investors actually treated like owners of the business, or are they looked at as sort of ever-changing, nameless sources of capital that require a little more than what is legally required disclosure, right? And there are many, many companies around the globe that take that cultural attitude towards providers of capital. A second sort of cultural thing to understand is that most countries outside the US lean more towards socialism, right? And that's important because the shareholder moves down the ranking of what's important. Employees are more important in some places than shareholders. What's good for society, at least in the short term, can get placed above what's important to shareholders. It's important to understand these things when you're looking at making a potential investment in where you rank. ESG has been a huge topic over the last 5 years. And there are many, many companies that go way overboard. It impacts the way people are paid, and it impacts the focus on returns. It's great. If there's a company that's really focused on ESG mandates, that's great. But I need to generate returns for my shareholders, and I need people who are focused on economics. And so it's really important to understand where the emphasis is and where the emphasis isn't. And it's vastly different outside the United States. So cultural differences matter. Now, this is pretty interesting. Just looking at liquidity, you can see that there's a different bid-ask spread depending upon where you trade. There's a lot more, places like Japan, somehow I'll put in a trade and all of a sudden the prices start to move. So the way communication works between all the broker-dealers is very different there than it is in other places. So that impacts your trading strategy. And just the amount, the average trading volume per day, which matters to somebody who's operating at scale, is very different outside the United States than it is inside the United States. This is a big topic, corporate governance. I'm going to spend a few minutes on this slide. And the way that we define corporate governance, everybody has slightly different definition. But the way that I describe it is it's a respected, underline respected set of laws that define the relationship between a company and its shareholders. At its core, corporate governance structures should allow for parity of influence based on capital at risk, right? And so what I mean by that is one share, one vote. And, we oftentimes take it for granted in the United States that that's the way things are. It's actually, there are several companies, Google is a good example where that is not the case. But outside the United States, this is oftentimes not the case. There are super voting rights, there are double voting rights. And in a place like the Netherlands, every single company has an entity with a separate board called a stichting, which is basically a protection mechanism that can be implemented if there's a shareholder that accumulates stock over a certain level. It's basically an anti-takeover device. And being aware of these things is very important. Another important aspect of corporate governance is a proper separation between those who supervise the business and those who operate the business. Here in the United States, oftentimes the chairman and the CEO are the same, although that's starting to change. In the UK, the chairman is separate from the CEO, and the chairman's job is to supervise the people who operate the business. In Switzerland, the chairman's job is not only to supervise, but the chairman's job is to actually set the strategy of the company. In Japan, for the most part, there are very few outside directors, which means that the chairman and the CEO is the same person, and all the other members of the board are all employees, and they work for that person, which makes it virtually impossible to have a separation between the people that are operating the business and the people who are supervising the business on behalf of the shareholders. These are very, very important things to understand about what you're actually buying. And these concepts are basically taken for granted in most U.S. investing. It's just outside the U.S., the rules vary very widely, and they're very important. So let's discuss why I use the phrase respected. And this gets a little bit back to what I mentioned earlier about cultural differences. There are many constituents, of course, for a business, including operating executives, shareholders. There can be founding families with control or influence. There can be a government that controls the business. The local legal and judicial system can vary widely, and they're responsible for enforcing their rules. There are certain small countries where there are, let's say, 5 big law firms, and if you're involved with a company and you're engaged with a company, if you sign up for those law firms, they now have a conflict, and so the other party only has one law firm to choose from. Like there are all these things that you have to think about, and they can do the same thing to you. There are also politicians that may or may not play a protectionist role and have the power to change the rules. They can simply, change the rules. It is not uncommon for companies outside the United States to have national champions, for example, and try to be protectionist about those. That we came across that when we were engaging with Danone, and I was thinking to myself, really? They make yogurt, and this is the national champion? My goodness. All these constituents have different agendas. They can vary widely from a large country to a small country and from a developed market to an emerging market. But the key is how much respect do these constituents have for the rules, right? Respect for the set of laws that are there. Because if the rules aren't respected, they're absolutely meaningless. I guess probably the example that might resonate the most is that if you're investing in Russia, what really matters? The laws that dictate your relationship to the company or what Putin wants, right? So that's a really obvious and extreme example of what goes on. Okay, what's available to you is different than what's in the United States. Don't forget that the industrial base, although it's partially being rebuilt now, but the industrial base of the United States was gutted decades ago. As a result, the U.S. is a service and innovation-based economy. And you can see here that the weighting of technology and healthcare is very high, while outside the United States, you get the pleasure of choosing between industrials, financials, and consumer discretionary businesses. So what you have to choose from is vastly different. Guess what? Not everybody uses the dollar. So we have to think about currency, right? And the first order of business in thinking about currency is how it impacts the actual operating business that you're investing in. So I'll just put a minute on this because this gets kind of technical. But if you have a company that's domiciled in Europe, they're operating in euros, and they have a large business, let's say, in Japan, if the revenues are in Japanese yen and the costs are in Japanese yen, and the yen declines in value, then the net profit gets translated back into euro at that lower rate, right? So that's, when you think about that business, that's just a translational impact. It's still meaningful, but it's translational, as opposed to transactional, where let's use the same example, except the revenue is in yen and the costs are in euro, right? Where you have an exporter, right? And that's very different, where your revenues go down and your costs stay the same, then you have a transactional impact. And so when you're looking at investing in businesses, you better understand the structure of that business. And then you have, your exposure. So if I have 30% of my portfolio in euro, and the euro is meaningfully overvalued, right? And we look at things like purchasing power parity, we look at the Big Mac index, we look at the economic structure, political structure. Germany, for example, is a large exporter of automobiles. We put some of this here. Some countries are exporters, some countries are importers, and they export and import different things. So it's important to understand what the makeup is of each of these economies when you're thinking about what it means to have an overvalued or an undervalued currency. And that has an impact on your evaluation as to whether or not a currency is over or undervalued. We don't do a lot of hedging, but there are periods in time when we have a meaningful exposure to a currency where you can take a look at some of these metrics and easily conclude that a currency is overvalued. And then it doesn't come for free, actually. You have to pay for it, or sometimes, as it is today with the Japanese yen, it all depends on interest rate spreads, inflation spreads, responsibility, who's running a deficit and who's not, a budget deficit. But you can get paid for putting on a Japanese yen hedge today. So all of these things, you're in the US, you've invested in dollars, you earn in dollars, right? And that's not the case outside the US. And I know some of these things sound obvious, but it takes time. Okay. Interestingly, the United States is the largest investor, right? Whether it's through vehicles like we run or it's direct, the United States in most markets is the largest investor in foreign markets, right? We are savers and we are risk takers, right? That's good, right? Because that's good for the United States. The UK is similar, but it's just a small country. Europeans tend to have very good retirement plans, so they don't take a lot of risk with their money because they don't have to. This is really important to think about. Look at Mexico here, 67%, right? So what happens when things get rough, right? When things get rough, the economy in the US is not doing well, things are slowing down, people start to get frightened. The stock market's driven by fear and it's driven by greed. And when people get afraid, they bring their money home, right? That's what happens, especially in emerging markets where I always say emerging markets are at the end of the liquidity spectrum, right? And in a place like Mexico, that can have a meaningful impact when markets are going down. So these are incremental things that you have to think about. Some other small ones to think about are sometimes local markets can have a lot of individual investors who, don't really know what they own and don't study, and they can push markets around in kind of wacky ways. And then what's listed and what's not. So you can see here, Germany is really interesting. Market cap to GDP is not because the valuations are depressed. It's basically because there's a large group of businesses called the Mittelstand that just aren't publicly traded. They're all privately owned. So the amount of commerce that's traded on the exchange can vary significantly from country to country. Something else to think about. Okay, market access. This is Jeremiah's favorite subject here. The plumbing can be very cumbersome outside the US. You need a global custodian, you need a local market sub-custodian, you need a securities depository, you need a local bank to settle transactions. Each trade requires a foreign currency transaction, right? And who does that transaction, what kind of spread you're getting on that trade matters. It can get very costly if you don't manage it. Some of the more complex markets like India, they have onerous disclosure requirements. It requires extensive documentation that can take months and months to process. You have to pay registration fees. In order to repatriate your money, you need a local tax consultant. And again, just a simple example, just to get you to internalize this is very different than opening up a Schwab account and buying shares of Apple. You would think collecting dividends would be easy, right? Just give me that one, but it's not. There are all sorts of treaty agreements. You have to have a system and a process in place to reclaim withholding taxes. Sometimes you can't get it back. We have this, the broker-dealers have come up with this mechanism where you lend them your stock to their local subsidiary. They collect the dividend, so you don't lose the withholding tax. Of course, they take a vig for that and send it back, so you have to put that system and process in place. The rules are very, very complicated, and in some cases, it can take years to get your dividends back. Okay, this is really interesting. Corporate tax rates vary widely from country to country. So just to again use a simple example to help you internalize why this is important. If I have two businesses, one in the United States and one in, let's see, what's the lowest? Switzerland. Let's say in the US they're paying a 20% tax rate, so you get to keep 80% of the profits, and in Switzerland you're paying a 10% tax rate, so you get to keep 90% of the profits. If it's the same business with the same profitability at the same growth rate, obviously the business in Switzerland is more valuable. I'm keeping more of the profits, right? And that, is important and it's meaningful, and it can also be a competitive advantage. So for example, we own a company in our portfolio called Arch Capital, which is a property casualty insurance company. It's domiciled in Bermuda, pays a very low 8% tax rate. On much of its business, it pays 0. And they're selling a commodity product, and they're competing against US companies that have a much higher tax rate. So they could use that advantage in one of two ways, right? They could lower the price of their product, take market share, and still earn a good ROE, or do it the way that they're doing it, which is the way that I far prefer it, is sell the product at the same price and earn a higher ROE and compound book value at a much higher rate. So you need to be aware of these tax differences, and because it could have a meaningful impact on your rate of return. Okay, so those are just a few of the complexities that we manage. The message here is don't try this at home. Leave it to us. And it's complicated. And we actually view this as a positive, right? Because complexity creates a knowledge gap. And the wider the knowledge gap, the greater the inefficiency, which for us leads to opportunity. Okay, so here's the second part. Why is international investing a natural hunting ground for value investors? We mentioned this a little bit earlier. It's important to understand that non-US markets are less liquid. It's also important to understand that most of the investable universe is in Europe and Japan, if you're managing money at scale. And you might look at this chart and say, oh, look, but China's pretty big. But we put a little indicator here about state-owned enterprises, which represents 28% of emerging markets. And that's a huge number, and it's really important to understand because these companies are controlled by the government, and the government has different goals and objectives than shareholders. So even if emerging markets makes up a decent chunk of this slide, it's not all available to you. So that's one reason why there's just less liquidity. But here's the main reason. We talked earlier about the fact that the US is an innovation-based economy, right? We're less socialist than most countries. And this is what that leads to, is faster GDP growth, right? More innovation-based companies. We talked earlier about the makeup of the indexes, or what's available to you in terms of market cap, right? You can see here, we're the only country that doesn't have we have a big socialized healthcare system, but we're not fully socialized. Everywhere else in the world is socialized. It has a meaningful impact. Even this healthcare weighting in Europe are basically old line pharmaceutical companies, right? They're not the sort of med tech, innovative biotech companies that we have here in the United States. So it's a vastly different animal. So what do we get in the United States? We get faster growth, right? That's the orange line there, which lends itself to growth stock investing. And during most periods, you get a higher return on capital, right? So if you think about this in the inverse, outside the United States, you get lower growth and you get lower return on capital, right? So that is a tough place to be a growth stock investor, right? However, it's a great place to be a value investor. You have slower growing companies. When they have problems or they have hiccups, people don't want to own them. They get severely mispriced, and it creates a very, very fruitful hunting ground for people who are value investors. I put this slide in here. It's kind of a crummy one. I should probably refine it, but I was running out of time. But what I was trying to point out is when you look at what's available to you in those indexes, and telecom kind of points it out, right? Like, who really wants to buy Verizon or AT&T, right? Unless it's handed to you at a ridiculously cheap price. But Deutsche Telekom makes up 6% of the German index, right? NTT makes up 2% of the Japanese. These sort of mundane companies are a much larger component of non-US indexes. And it just, it reinforces that point that, what you're getting outside the United States is very different, and it lends itself to value investing. So in summary, investing outside the United States is complicated, with economies and businesses that grow slower and have lower returns. It's a tough place to be a growth stock investor. It's a great place to invest if you live off of mispriced assets. So the question is, so how do we do it? Well, most of you already know the answer to this question, so I'm just gonna say it again anyway. I've been saying it for 20 years. This is how we do it. So we look for businesses that have 4 key characteristics. They're cheap, they're undervalued. Not cheap, they're undervalued. There's a difference between those two things. And we like good quality businesses that have the ability to grow over time to protect our purchasing power. We like businesses that are financially strong, and we look for a management team that has a track record and history of adding value over time. Now, it's unusual to find a security that embeds all 4 of these characteristics. So we're needle in the haystack people. And generally, you have the ability to invest in a security that embeds all of these qualities when companies are having problems. So for example, during the pandemic, we had an opportunity to invest in Ryanair, right? You would say, airlines, geez, who wants to invest in an airline? Well, Ryanair is a special airline. Ryanair is a low-cost provider in Europe. It is the largest passenger airline. It's run by an extraordinary CEO, who's also a very large shareholder, who runs it with no debt. And in the midst of the pandemic, when everybody stopped flying, Ryanair had a lot of money, put in a big order for new jets with Boeing, and ran around Europe signing new airport deals for all these airports that were losing money, leading to a 50% increase in passenger volume post-pandemic versus pre-pandemic. That ability to take what is a good business that's growing very nicely and create enormous value gives us the opportunity to make lemonade out of lemons. And this is the song that we sing. All right, hit it. Who's hitting the button? So this is what I like here is this. This somebody's pain is somebody's pleasure, somebody's trash is somebody's treasure, somebody's ugly is somebody's lovely. It really does sum up what we do as value investors. So we love this.
Somebody's pain is somebody's pleasure. Somebody's trash is somebody's treasure. Somebody's ugly is somebody's
presentation. As always, for those of you that I
Lemons
don't
give
know,
you
I'm Ed
lemonade.
Omada. I'm one of the business leaders on the International Value team. I'll be quarterbacking the Q&A portion of this presentation as well as the next one. So if you have a question, please raise your hand. We've got some microphones out there in the audience so everybody can hear. If you're watching online, please submit questions. We'll get to as many of them as we can before they kick us off stage. But real quick, just humor me for a second. Eric and I had a little wager. How many people in the audience have actually heard this song before you walked in this morning? Anybody?
Aha! Aha! We have people in the room.
We set the over-under at 1, so I guess the over hit. Good call. Good call. 3? Spot on. Yeah. Okay. Any questions in the audience for David? Can be about this specific
Wait,
presentation.
how many people correlated with value investing when they heard this song?
That's a 0. Any questions for David? Could be about the presentation or anything really in general.
Can you just share from your perspective what you think makes your team somewhat unique or somewhat more well equipped to capitalize on the things you talked about? Because the 4 main components of a good investment are, the basic concepts are not unique. We've heard them before. But your team, apparently, we all know, executes in a somewhat different way or achieves something different than people who have the same 4 goals. So what do you think makes your team different?
The true answer is I don't know because I'm not inside other people's teams. And investing beauty's in the eye of the beholder. I can show other investors what we own, and they can see it anyway. I talk to people about Samsung Electronics until I'm blue in the face, and nobody wants to buy it. A lot of people can't buy it, right? It's just very hard to buy a security in South Korea, which is another one of those complexities, right? Why does it trade at such a discount? Well, most tech investors just can't buy it. But we have. So you're going to hear from, sort of the next generation of people who are executing this same strategy that we have in a minute, right? They do this. And if you are diligent and you do this right, you are exposing your shareholders to a set of economic variables that if you continuously do this year after year after year, you're exposing them to a set of variables that should create wealth over a long period of time. And you have to do it diligently. You have to do it seriously. And I'm going to give Eric and Andy Ziegler, the founder of Artisan, you have to be placed in a position to do it without an institutional mandate, right? I've met several other investors who are sort of in my sphere of value investing. I would sit down with them and I would say, well, why do you own this? Well, I'm hiding in that stock. Or I think it's better to own this because the index might do this and I don't want to put the business at risk, right? I never have to think about that. The only thing that I have to think about is generating wealth for my shareholders, right? So I don't have an institutional mandate, or if I had one, I ignored it. We're diligently, and I have a team that only does this. And if they don't do this, they know where the door is. There's no other question other than we do this. And if you go to Fidelity, for example, and I don't remember who gave me this notion, but if you go to Fidelity, they have all these analysts all over the world, except Fidelity has growth stocks and value stocks, and they all feed off of one research team. So if you're a securities analyst, you have to feed several masters, right? The folks on my team, and this is the way we're set up, they do one thing. They invest in non-US stocks, looking for companies that display these characteristics, and that's it. They don't do anything else. So they're very focused on doing one thing. Now, I'm sure there are other platforms that are out there that do the same thing, but I can't point to you, what the meaningful differences are in the way that they operate day to day and the judgments that they're making when they're looking at individual securities. So it's very hard for me to answer that question.
I did. You gave Alibaba as an example of kind of all of these points. Can you speak to kind of provide an update on the plan for a potential breakup of their businesses and basically kind of sum of the parts analysis within China versus other parts of the world?
Well, Alibaba is hard. China in general is hard given the geopolitical tensions. What's going on with Alibaba is a result of a confluence of events that have taken place over the last few years. It started with scotching the IPO of Alipay, and then the Chinese government came in and put some competitive rules around the way these companies operate, which is really interesting. If you listen to Lina Khan, she was on CNBC the other day. She was, it must be hard to do from the FTC, but she was talking about trying to implement some of these same exact rules to the US large technology platform companies. But anyway, the implementation of those rules and the resurgence of an actual cost of money, right, which keeps venture capital companies from continuing to fund uneconomic businesses, has resulted in a mandate at Alibaba to take all of their individual businesses and have them operate on their own, right? The way it works now is they make all their money in Taobao and Tmall, and that subsidizes a whole bunch of loss-making businesses. And if you just take the market cap and you subtract out the cash and you just look at the profits coming out of Tmall and Taobao, you're paying 3 or 4 times earnings for that business. And then you have a whole host of other businesses that are losing money. So when people look at it, they say, oh, it's at 9 times earnings, it's a Chinese company, it's fairly priced, right? But the reality is many of those businesses operate at scale, and the competitive dynamic is getting, in some areas, less intense. Tmall and Taobao, competitive intensity is actually increasing, but for some of these other businesses that are losing money, it's decreasing, and they're very focused now on generating profits and access to capital on their own. And so you've seen announcements of, oh, this subsidiary is looking to do an IPO, or that subsidiary is looking to do an IPO. I think that some of that may be testing the water to see how the government reacts. And some of it is the reality that now that they're on their own for their own resources, they're going to have to access capital in one way or another, right? So job one is getting them profitable. So as these businesses, we can come up with the sum of the parts analysis where the stock is worth 4 times where it trades today pretty easily, right? And so, we sort of look at the geopolitical issues and we try to internalize how China is meshed in with the rest of the world. We don't want to forget the fact that we're financial people and we're focused on that, and politicians are political people, not necessarily focused on what we're focused on. But it would be very hard for China to go down the same route as Russia because of how integrated it is, generally speaking. And that's a very simple way of looking at it. So I think the odds are that things are going to be okay. But I'm not making a big bet, right? I don't have 50, 60, 70% of the portfolio in China. I have less than 5. But I own a security that's extraordinarily undervalued, and at 2.5% of the portfolio, if it goes up by 4 times, I'm going to make an awful lot of money. So that's the way that I think about that.
I think we're out of time. So thank you, everybody.
Thank you.